Hi everyone, George here. I want to bring to you a simple tutorial with respect to a deceased tax individual. So with tax season around the corner, I think this would have been a great piece of knowledge to have for the upcoming tax season. So in my particular example, but before I go any further and I forget, I'm not a CPA nor a financial planner. I'm simply giving some tax knowledge for your viewing pleasure. So on to with the example. David Smith was a hard-working repairman for Norco Hotel, a utility company. Unfortunately, he had a workplace injury. During the year, he had a T4 for $27,800 and a T4A for wage loss replacement in the amount of $30,000. Of the $30,000 he received, he previously paid $15,000 in premiums he never deducted, and he paid them from his own pocket. Sadly, by 1st of September, he succumbed to his injuries and passed away. Prior to his death, he sold Air Canada shares for $7,500, of which he initially bought for only $500. He also held Bell Canada shares worth $50,000 on September 1st, but originally purchased for $120,000. So with this in mind, all these facts in mind, let's turn to UFile and see how I would enter this information in UFile in order to uh, finalize this person's tax return. All right. So I would start with identification, and in the identification section, you clearly need to identify the taxpayer, Mr. David Smith, social insurance number. All this information is fictitious, not related to any known real person. Um, his date of birth, 16th of August 1980. Lives in good old Alberta. Why should we not forget Alberta? It's a beautiful province. And marital status is single. No change in marital status. Next. Alright, clearly identify the taxpayer's address under current address. 1234 My Street, Calgary, Alberta, Tango 9 Romeo 3 Kilo 3. Fictitious phone number. There you go. Easy breezy so far. CRA questions. Hey, language of correspondence, English, could be French. And are you filing a tax return for the first time? No. Do you own foreign property in 2020 with a total cost over 100,000? No. Did you sell your principal residence in 2020? No. Are you an officer of another country, diplomat? Of course not. And I'm with the Elections Canada questions, I'm saying yes to both. Reason being is, what other way do you have of communicating your date of death to Elections Canada? Climate action incentive. Um, you should pick this, answer this question in order to apply for the climate action incentive. But in this case, since he passed away, he might not be entitled to it. We'll double check that with the output. Okay, and do you accept the terms and conditions for email notification? Let's skip that for now. And let's get to the interview setup. So in the interview setup, it's very important to select tax return for a deceased person, T4, T4A, because that's where a wage loss replacement is usually reported, and capital gains. All right, let's get to the deceased menu page. So we enter his date of birth, date of death, 1st of September 2020, final return. There is no subsection election under 104.13.4, and that's beyond the scope of this video. Let's go to the T4. Norcotel. We selected the first option, which is any T4 for any province other than Quebec. We enter in his employment earnings, province of Alberta, CPP contributions, EI premiums, RPP contributions, and the pension adjustment. Usually, all these amounts are fictitious, but usually the PA amount is twice the RPP contributions, and $3,100 deducted at source. Awesome. Next will be his T4A. And under T4A, fictitious name Western Trust, he received wage loss replacement. So under other information, there's a drop down list here, and select 107. Payments from wage loss replacement plan, 30,000. In a subsequent data entry cell, I'm going to select note premiums paid to wage loss replacement plan, 30,000, 15,000. The two amounts should subtract from one another, giving us a net 15,000. And now on to capital gains. Under the capital gains interview sheet, I select stock mutual funds, Air Canada shares. The Air Canada shares in this column here appeared after I typed it in here. So if I type CCCC, it also copies that on the left-hand side display. All right, so 1,000 shares, and again, that's a fictitious number. He sold them prior to his death, let's say the 8th of August 2020, for $7,500, and that this would be reported on his investment summary slips, or the famous T5008. And the adjusted cost base of his shares were $500, basically the cost that he bought them for. He also was holding on to the Bell shares. Now, why am I reporting this as a sale? I'm reporting this as a sale because this is what is called a deemed disposition. So whatever capital property the deceased was holding on the date of death is deemed to have been disposed. So the fair market value on the date of death was $50,000. That is what is deemed to be his proceeds, and the adjusted cost base was what he bought them for initially, which is $120,000. So obviously this is a loss. Let's see how everything transpires on the return now. Click next. Let's go to review, summary, the summary, and very few warnings. I think the return calculated successfully. We have a summary of a total refund of $3,900. Let's quickly review the return to see how everything is reported and how this refund was reached. Okay. All right, let's start with page 1. Page 1 of the return is pretty straightforward. Estate of the late David Smith. That little phrase was automatically entered by UFile once we entered the date of death. He resided in the province of Alberta, not on December 31st, 2020, but what December 31st, 2020 represents this, in this case, is his taxation year end, which is actually September 1st, 2020. This date is fixed by the prescribed CRA form, but keep in mind what they mean by December 31st, 2020 is not actually December 31st, it's a tax year end. And again, the tax year end for any deceased individual is the date of death. All right, let's continue. Elections Canada, everything here is pretty straightforward. Let's take a look at his employment income. That's properly reported, $27,800. The $15,000, recap, it's his wage loss replacement payments less the premiums that he paid previously and did not deduct against any other payments. And negative $31,500. And how do we get that amount? Let's double click on it. This is what we call a drill down. And it'll take us to the source document where the calculation was done. It's actually on Schedule 3, capital gains or losses. And we have Air Canada shares, which he actually sold in August for $7,500. He bought them for $500. Net gain is $7,000, half of which is taxable. For the Bell Canada shares, they're deemed to be disposed on the fair market value, the date of his death. I'm assuming that it was $50,000 for the sake of this example. He bought them for $120,000 for a net loss of $70,000. And if we sum up the gain from the loss, we have a capital loss of $63,000 and a taxable capital loss, which is half of the gross amount, of $31,500. Now, if you do a little bit of research in the deceased guide, you'll see that the deceased taxpayer has two choices: either carry back the loss, or a portion thereof, if I recall it correctly, or use that non-capital loss in the current year against income. Now, I vaguely remember the rule, but I do know that UFile does it accurately. So let's go back to the tax return and see that the addition is all done properly, we're only left with a total income of $11,300 when we subtract the registered pension plan deduction and a couple of other credits. He's only left with a net income and a taxable income, more importantly, of $9,700 and $9,724, which means that that amount of taxable income is less than his non-refundable tax credits, and he has zero tax to pay. In turn, what the taxpayer will get, fast forward to the fourth or last page, is, as you can see, tax payable is zero. Therefore, he's getting back the sum of all his taxes deducted at source. Any Canada Pension Plan and EI overpayments are also credited to his account for a total refund of $3,959.07. So two major takeaways from this video are, with respect to wage loss replacement, whether you're deceased or living, and you've paid premiums to those to that wage loss replacement plan, and you previously did not deduct them, you can deduct them in the year that you receive payments. Secondly, deceased taxpayers have a deemed disposition on all capital property held on the date of death. If that capital property is worth less than what the original investment was bought for, you may have an interesting tax deduction on the deceased tax returns tax return. So I hope you enjoyed this video. I know ordinarily I'm making videos about my beloved hobby, which is strategy and tactical games. But from time to time, I like to dabble in tax because tax is my day job and my hobby. And I love it. And I hope you enjoyed it as well. And remember those two takeaways. Uh, Wage loss replacement premiums can be deductible. And two, deemed disposition on and special tax treatment for capital losses, taxable capital losses for deceased taxpayers. Take care and have an excellent holiday season ahead. Take care.